Charles, maybe tell us a little bit, just a little bit about yourselves, right? I mean, you've been investing for a long period of time. We have gotten to know you really well at Ara, but prior to that, you were with Intervale, and we actually had Jason Arnoldi from Intervale come and speak at, I think, the second ADI forum many years ago. So, but tell us a little bit, like, I mean, how did you get into investing, and then we can talk a little bit about Ara as well.
Sure. Well, I've been doing private equity now for over 30 years, and came to it in a sort of a strange way. I was a nonprofit guy. I thought I was going to be a psychiatrist out of college. I worked with a population of, this is in Boston, deeply disturbed youth, would be putting it mildly. It was the most challenged kids in the greater Boston area, 1-to-1 staff to student ratio, and that wasn't enough staff. And you sort of measured progress in the lives of these kids in very small increments. If they went from punching the weakest kid in the school to throwing an ashtray through a window, that was really good progress for a year. And I panicked because it just wasn't patient enough for that kind of work. Went to business school, went to Wall Street out of my MBA program, met my wife, who was in New York on a break from her field work in Vietnam for her anthropology PhD. I really liked her. I followed her with Credit Suisse at the time, and then got hired away by a private equity firm, and ended up doing the first post-communist deal in a Vietnamese bank, toilet bowl manufacturer, resort, office building, sneaker manufacturer. And all I can say is that the very best day investing in, the early 90s in Vietnam was worse than the worst day I'd ever had at Ara. It was just, there was no law, there was no, it was a wild environment, but a great place to learn. I came back and just started investing on my own, doing pass the hat deals in the 90s. Came upon the oil field out of Boston, Massachusetts. And at that time, it was just an overlooked sector. Private equity wasn't covering it. There were a lot of really smart engineers and operators who didn't really know how to run a business. So if you could help them with a basic toolkit to kind of improve their business, you could buy right, and you could really help them to grow and generate a good return. So that led to forming a firm called Intervale Capital, now known as Amberjack. That was back in 2007. Raised a series of funds there. And through all of this, the overlay was have been since the 90s completely freaked out by climate. And I had 3 teenage sons at the time. This was like 2016. They said, all you do is talk about climate and you invest in oil and gas. You're a hypocrite. I said, fair point. But the ability to invest in decarbonization, which is sort of where I wanted to end my career, but with I think a much more collaborative posture towards the oil and gas industry. There just wasn't time yet. So we started in 2017 with Ara with just a sheet of paper and an idea. And that was to build a firm that wasn't just private equity guys like me. If you think about decarbonization, you're going to have to retrofit old plants or build new ones. Our view has always been, look, oil and gas aren't going away. It's naive to take that kind of West Coast utopian view that solar, wind, and batteries are going to save us. And if it's not solar, wind, and batteries, it's nuclear fusion. It's just around the corner. Like, that's just not smart, because what it does is causes people to ignore the conventional energy and industrial sector where all the emissions happen. Our view is you go where the emissions are. Fossil fuels aren't the enemy. The emissions are the enemy. If you can uncouple those things or offset them, then you're going to be able to have a much bigger and more immediate impact on climate. And as we all know, the tons we save in the next 10 or 20 years are much more important than the tons we save in 30 or 40, because if you save a ton this year with a repeatable business model, you're saving it every year. So we, recognizing that we didn't know how to build plants at Ara, have built a team of people who have about, I think, $500 billion worth of construction and commissioning experience to help us evaluate process technologies, develop projects, construct plants, commission, operate, and optimize. So we're really known as a builder firm, and that's sort of how we get to where we are today.
Ara has almost developed an owner's engineering team within within the firm to kind of help your portfolio companies develop their often first-of-a-kind projects and things like that.
That's right. And it's just as important as everything else we do. So if you think about Ara, it has 4 different investment verticals.
So Charles, sorry to interrupt, but before you get to talking about Ara, how hard, how easy was it to raise the fund for Ara?
Fund 1 was the hardest thing I've ever done. It's 2017, the idea of industrial decarbonization was completely Greek to the institutional investor community. Plus, we didn't have any proof of concept. So what we had to do was essentially fully seed our Fund 1 portfolio by borrowing, getting bridge loans, putting our own money in, doing whatever we could so that there was enough proof of concept to persuade investors. And then we finally got a $400 million Fund 1 raised in March of 2020. When you're doing something new in private equity or in the investment world, you think about being an institutional, let's say you're running an endowment or a foundation, a pool of capital. You're not going to get fired for investing in KKR or Apollo, even if it doesn't go well. You might get fired or at least get a lot of negative attention heaped upon you if you try something new. And so you have to make the unfamiliar as kind of approachable and familiar as possible. So that fund took 2.5 years to raise, and we look back on it with a mild sense of trauma. It was really hard.
And since then, you have raised 4 funds.
Well, inside private equity, which is the kind of the quote unquote the flagship, we closed a $3 billion Fund 3 in late 23. So it went from going very slow to going quite quickly. We also have a infrastructure, decarb infra platform that focuses on transport, storage, processing of green molecules. So think RNG, biofuels, et cetera. And the most recent vertical is focused on conventional energy decarbonization. So we're buying natural gas power plants, biorefineries, and downstream distribution businesses. That's run by a guy named Shimi Konar on the investment side, who previously ran Pilot, Flying J, which was the truck stop company. They sold 1 million barrels of fuel a day, huge number of, I think they were the biggest biofuel seller in the country as well. So his ambition is to try to do for the conventional energy sector what we're doing at Ara Private Equity for the industrial sector.
So maybe if we can take a step back and now describe Ara, and so there's the team that's effectively, let's call it your owner's engineering team, right? And then there's this infrastructure fund that you're doing with Shamik. And what are the other pillars of?
So just in terms of the investment verticals, infra, energy, private equity, those 3 verticals, and private equity is the oldest and therefore has the most under management. In terms of the specialty functions, you've got the builder team. They're all the usual private equity guys, right? Like they're boring. You've got the builder team. We actually have a government relations team. The firm's about 90 people. Government relations is 6, and probably our most profitable business last year. They raised almost half a $500 million in Washington, tax credits mostly. So, and then we have a carbon accounting team, which is very good, and that's run by a woman named Irina Markina, who was a climate advisor to the EU for a decade. If you're in this business and you can't keep score in a gold standard way, you can't stand behind the savings you claim, there's no point in being in business. And she's probably the scariest person at Ara to the private equity team, because she can kill a deal by coming in and saying, look, the claims that this company is making or that you're making as a deal team are just they're not valid when we do the deep dive. So she will kill a lot of deals. That's not her joy, it's just her job, and she's very good at it. And she also helps companies, once we own them, try to drive their own internal emissions to 0 if they're not there already. So those 3 functions, builder, gov relations, carbon accounting, are super important to the way Ara does business, and they support all of those 3 verticals and the investment teams in the verticals.
I mean, we do a lot of work with private equity firms, and obviously the large players like KKR and Apollo obviously have functions that are similar, but I don't know of a lot of funds that are I mean, Ara has a big fund, but it's relatively a much younger fund. So in many ways, you've had to add these because of your focus on decarbonization. Would that be a fair statement, or?
If you're going to do industrial decarbonization, just to come back to, I mean, it sounds really simplistic, but it's true. Either you're building new plants or you're putting kit on old ones to make them less polluting. That's how you're going to do chemicals, you're going to do critical materials, you're going to do, fuels, etc. It's going to involve building. And it's going to involve assessing process technologies, picking the right ones, and you're using those technologies to do that building. If you leave it to, if I showed up on your 777 and said, hey, I've never flown one of these before, but I'm gonna take over, you guys good with that? That would be a really bad idea. But yet private equity does that again and again. Private equity people, the investor community say, we're smart, we'll figure this out, we'll hire some guys, we'll figure out how to work with an EPC firm. And when an EPC firm sees a private equity firm show up with a wheelbarrow of money, they just start licking their chops. They know exactly how that's gonna go. You can't be in the business of building things without people who've done it for 30, 40 years with, a tremendous track record. It's like flying a plane. It's a repeatable, predictable process. But the idea that you're going to show up and do it without any training or experience is crazy. And private equity has made that mistake repeatedly. And so if you view private capital as a part of the climate solution, which we do, an important one, you can't approach it in the conventional way because, a person who was an M&A investment banker and then building financial models and doing due diligence just has no idea how to build or operate a plant.
Yeah. So maybe can we talk about the portfolio a little bit?
Sure.
And I'll let you decide how you want to segment it. You could segment it based on these three, the way your firm's organized, or maybe at a high level talk about hydrogen, electrification, carbon capture, whatever way you think and frame your portfolio in.
Well, let's talk, I'll give you an example in the hydrogen space since that's germane to this crowd. We have a company called Utility Global that uses a membrane system to separate hydrogen from some feedstocks. So we're kind of in stealth mode. We are talking to every major steel company in the world about decarbonizing their blast furnaces. Blast furnaces are responsible for 70% of steel production. And I hope I'm not offending anybody if I ask them if they've heard of H2 green steel, also known as Stegra. It's in Sweden. They're using electrolysis and renewable power to make green steel. That's lovely, but it's 7 times more expensive than regular steel. And no one's going to buy it, other than maybe a few people to please their customers or their board. It's not a scalable strategy. If you want to decarbonize an industrial commodity, you've got to be at cost parity. And with utility, we can decarbonize steel at cost parity by taking carbon monoxide off the blast furnace, running it through our membrane system in a water gas shift, and getting hydrogen and CO2. If there's a price for putting the CO2 in the ground, which there is in many places in the world, then you can actually help them reduce their emissions by 80% by putting hydrogen back into the blast furnace as a fuel. You got to keep some met coal because you got to have the carbon monoxide off the smokestack to make the hydrogen. So you can't get to 100%, but that's another rule in this business is don't make the perfect the enemy of the good. 80% is spectacular. Every ton you save is spectacular. Saving 10% on a natural gas-fired power plant is spectacular. If that's 2 million tons a year, you just save 200,000 tons. So we really we take a pragmatic approach. We obviously want to go for deep decarbonization, but we're not going to take less than deep as a reason not to do a deal because it's still a net positive. So that company can also help with mobility. That membrane system can be used to take natural gas, turn it into hydrogen. It's a modular solution superior to an SMR in terms of cap cost and operating cost. So that's a business that we invested out of Fund 1. And with that smaller fund, we had to invest earlier in process technologies. So kind of a couple of brilliant scientists, their membrane cartridge worked. It worked in a robust way. It had passed the tests that we knew meant we weren't taking technology risk. There was a lot of perfecting of plant design so that it could be functional at an industrial scale that had to happen over several years. Ran it in a test facility at a steel mill in Canada, great success. And that company is poised to achieve great things this year, should be announcing some pretty major deals. That's the kind of deal we love, where we are able to do decarbonization. We're not changing the price of the commodity for the customer, and we can generate a good return on those plants. So that's kind of the recipe of what you look for. And by the way, for every company like utility we invest in, we are looking at hundreds that we don't, and they fall down for all the reasons you might guess. The economics aren't what were advertised. They say that the technology is de-risked, it's not. They say their uptime is 90% plus, it's 40. And then the most important thing in a way is, like, do the dogs want to eat the dog food? The customers want to give you a long-term take-or-pay contract that gives you the confidence you can go build a plant. We're not going to do it on merchant. We can't take that kind of risk with the amounts of money we're talking about. And we've made mistakes in companies, I'd say particularly in plastics recycling, where we've just gotten, our head handed to us. The market it was flooded with virgin products, and we've got two of those companies in Europe, and the Nestle's and the Danones, the kinds of companies you would expect would say, we're all in on this recycled stuff. This is mechanical recycling. We were in on it, but this virgin stuff's pretty cheap, and so they'll back off. You're making a great product, you've got the right process, but you're not able to get the long-term offtakes or the strength of contract to make those businesses viable. I'd say that's probably the most important thing for us to understand. In a world where long-term take-or-pays are not common, you've got to be 100% confident you can get those kinds of offtakes to make these plants work.
Can you talk a little bit about USD Clean Fuels? You think of them as more an infrastructure investment.
That's in the infrastructure vertical. So what do you look for in a decarb infra deal? So you're trying to find ways to reduce emissions. And so if you take an ethanol plant and you're figuring out how to get your product from the plant to the customer, what you find in a lot of cases is that there are diesel trucks going back and forth on the road all day and pissing off the local, population and causing a lot of pollution. Well, what if you could build basically a spur from a main rail line, put the transloading facility right at the plant, take those trucks off the road. You're going to get 15 or 20-year contracts from the Class 1 railroad, and you're going to be able to reduce emissions. That's a modest reduction, to be frank. It's a nice one, but again, you need to do 50 USD deals to match taking 10% of the emissions off of one power plant. Now, which one sounds better? We're getting all these diesel trucks off the road. It's great. That's 5,000 tons a year. That's great. That's 800 cars. But the more scalable opportunities from a decarbonization perspective are often lower in percentages, but much higher in tons. And you have to really fight an uphill battle with investors to kind of understand that, like, it's about the tons, it's not about the percentages. Hopefully it's about both. Anyway, in the case of USD, it's just a fabulous business. You have long-term offtake contracts. So when you enter a business like that, you're going to have let's say a 9% cash flow yield for 15 years, no matter what. And then if you can build multiple copies of that transloading facility and that rail spur, you're going to start to get real operating leverage, and the returns on those investments will grow higher. So that's kind of what's called a buy and build infra play. You're not just buying a toll road and harvesting the cash. You have a cash flowing asset, and if you can build multiple copies of that with the same management team, you can take what's considered infra risk, real downside protection, and then start to move up towards private equity returns.
So, it's a tough business, right? You have, on the one hand, investors who are looking for returns, investors in your fund who are looking for returns. And on the other hand, a lot of energy transition businesses don't have, there's not sufficient visibility and certainty into cash flows, right? So when I look at Ara's portfolio, it feels like it almost looks like the R&D portfolio of a large company. I started my career in the R&D sector at ConocoPhillips, right? So you'd have projects that are swing for the fences, but relatively high risk. And then you're investing also in a lot of projects where you're helping existing assets get incrementally better. Is that a good framework to look at Ara's portfolio, or?
I know that's a hurtful way to look at it. I'd say in Fund 1, so here's what, for a process technology rollout, here's what we need to see. We need to see, at a plant level, unlevered IRRs, meaning just the cost of the plant over the cash flows it's going to generate under long-term contract, of 20% or higher. We want a 10-year take or pay or longer. We want no technology risk. We'll take minimal scale-up risk. We need to make sure the dogs will eat the dog food, right? That's so important, and that's, in a way, the hardest thing to validate. Everyone says, oh yes, we love you, but you actually have to have that contract before you build a plant. You want to be a control investor. You do not want to be in a venture setting where you've got 7 venture investors around the table. They hate each other. They can't make decisions. Control investment is very, very important. And there has to be a huge technological moat around the model. What's the point of building a plant and then finding out it can be copied and you've got nothing special? And then you want a big addressable market. So I would say typically we want to see at least 100 plants. Sometimes our companies have, an addressable market of 10,000 or more plants. If you have all those ingredients, then the description you have laid upon it is, that risk is worth taking, because the prize at the end is enormous. It's, think of it as an industrial unicorn. You have sort of Silicon Valley economics because you can make copies of that thing over and over again, and it's high returning. It's industrial, meaning it's more capital intensive. So you really got to have those plant level returns be super attractive to do it. If you have those ingredients, it's worth taking the risk. But, Uday, to your point, Ara will be around in 50 years only if the companies that it is invested in sort of turn into industrial unicorns, because they're long holds, they're very labor intensive. We're putting 2 or 3 times the size of a normal deal team on a company like that, and then the presumption is that payoff is there. What if the market just values them as industrial enterprises and not as unicorns? So there's a framing story there too, where you're saying, listen, Mr. Buyer, you're going to extract a certain amount of rent from every one of those plants in that 1,000 plant market. We want you to give us a highly discounted piece of those forward profits when we sell the company. If we don't get that, we're just working triply hard for the same returns you could get doing a buyout, and it probably doesn't make sense.
Yeah. One of the challenges with this space is that the capital intensity, right? And you alluded to this a little bit, but when some of these companies are getting ready to build their first set of plants, right, you need additional sources of capital. And when I look at Ara, you have been successful in raising some of these additional stacks of capital, right? Through partnerships and interesting ways that you've gone about it. But you still, some of these plants are still going to need additional capital. That Ara itself is not probably sufficient to fund some of these plants. Is that a fair statement? Or?
Yeah, I mean, it's funny. It provokes 2 thoughts. One is, yes, there's a ton of capital, right? I mean, plant sizes can be $1 billion, can be $500 million. Some of them are much smaller. We've got an RNG platform taking supermarket waste, backhauling it, turning it into RNG. Those plants are, $50 or $70 million. And they generate great returns, and they have great long-term contracts, both for the tipping fees we get for bringing the organic or the supermarket waste. And by the way, what makes this company special is we can take the meat, the cheese, the apples, the oranges, the yogurt in the containers, just dump it all in, and we can process it en masse. The way supermarkets often have to work, you separate the organic stuff out of the bag, and so you've got all these back of the store people who you're having to pay a ton of money to do this. And by the way, when you go to one of this company's called Divert, when you go to one of their sites, all the food is good. I mean, you could eat anything in the bins. It's just that they don't have shelf space because supermarkets, even though they're a low margin business, are terrible at figuring out how much they should be ordering. So the company's called Divert because about 40% of the stuff they bring in goes to food kitchens. And by 2030, we should be feeding 1.5 million or 2 million people a year with that avoided waste. Those are easy plants to build, copy exact, cookie cutter, and because you've got 15, 20-year offtakes for the RNG, you've got long-term contracts for the feedstock, there's all the money in the world to fund those plants. So the point is, if you've got a repeatable modular plant design with great returns and great contracts, there's no shortage of money that we see on the horizon. But what you also start to realize is, we're going to do an exercise for the board of a major airline. We're kind of presenting to their board members to explain, okay, let's say we want to use SAF and direct air capture to get to 360 million tons of, low carbon fuel for the aviation industry by 2050. Well, what does that look like? How many dollars do you have to spend? And when you start to add that up, right now, by the way, we produce about 2 million tons, so the market's rather short. You're talking about such unbelievable quantities of money, it sort of boggles the mind, and it's also kind of depressing. So you just think about the EPC resources, the construction resources, the permitting, the capital needs. When you start to look at sort of systemic solutions to an industry's emission problem, it's pretty staggering how much capital is there. So we're fine as a firm finding all the money we need to build our plants. We are not fine as a planet offsetting all of these emissions, from everything from power to transport to, cement, steel, et cetera. You're just talking about trillions and trillions of dollars of investment. So it's a really daunting problem. I've sort of viewed my job before I die is to have the cookie cutters for industries that are ready to be stamped out. It's, just to be clear, this is a 100 or 150 year rebuild of the industrial economy to get there. It's not going to happen overnight.
At breakfast, you were talking about how it has been a steep learning curve at Ara. So can you maybe talk about that a little bit? Like what have been some inflection points?
Well, I think when I say you don't want me flying your 777, I don't think I was saying that in 2017. Having invested in oil field services and manufacturing, industrial services and manufacturing for 30 years, I knew enough to be dangerous. It's different when you're building, a drill bit manufacturing facility, with bringing in 5-axis CNC machines versus a process plant where you've got to make sure every piece of that process works independently, but more importantly, that all the pieces can talk to each other. You've got to know how to, go get into the sumo wrestling ring with an EPC and, be able to hold your own and not be exploited. Don't let them over-engineer. Don't let them change order you to death. Know how to go through that whole contracting process. So I think Ara, frankly, had the hubris of a lot of private equity firms at the beginning to say, we can figure this builder stuff out. We pivoted very quickly to saying, all right, if we're going to do this, we're going to have to spend twice the money to have that capability in-house. And that helps you avoid bad deals, because a lot of times your builder team will say, look, the technology is great, we trust you, but this plant doesn't cost $100 to build, it's going to cost $300, and here's why. Or the idea that this management team is not modeling in any contingencies in the construction project should tell you that they're naive and there are probably other things we should worry about. Nobody does that. The idea that you're going to price a plant to perfection is just a sign of incompetence or naivete. So there's just a huge amount to learn on the builder side of things. I think we've always been very good at picking good technologies. We haven't batted 1,000, but we've had a very high batting average. And I'd say really since some mistakes in Fund 1, we're basically, everything we pick at this point really works. We have the luxury now of writing bigger checks so we can invest in later stage process technology deals. But it's all around everything related to the development, construction, commissioning, operation, and optimization of plants. And I would imagine Ara in 20 years has more people in the builder fund and fewer, than it does in the private equity side of things. The investment side is something that's kind of scalable, and but it's a pretty labor-intensive process to build that owner's engineering function. We have 30 businesses now, so that requires a lot of bodies to oversee that work.
In terms of the next couple of years, I guess what does that look like? What are some milestones that you are looking forward to? What are some tests that you think are coming up here for both the fund and maybe some of your portfolio companies?
Sure. So we, in private equity, we do two kinds of deals: the process technology rollouts, but we also do buyouts of companies providing services or products to other decarb platforms. So, Priority Power was an Ara investment, and they're providing all kinds of services to people in the power industry, particularly in Texas, but now in, I think 30 states in the US. So structured long-term renewable power contracts, advice on how to build behind-the-meter installations, advice on data center operation and permitting, et cetera. Those sorts of businesses are pretty conventional deals. You're buying a set of cash flows, hopefully growing and improving the business and selling when the company's bigger. But what we're really known for are the process technology rollouts. Those are longer holds. And the way I would describe those deals for this room is you buy something, or let's say in Fund 1 we were buying much earlier, right? So when I mentioned utility, we've done years of work on utility. In our view, we've added an enormous amount of value, but we sort of view it as, just imagine you have a long march across the Sahara. Nobody gives you credit for that long march. When you get to the first oasis, suddenly you're worth a ton of money. You're worth 3, 4, 5 times more. That first oasis might be a big commercial offtake contract, which proves that a customer's willing to commit to you and kind of lash their strategy to you. The next oasis might be having the plant built, right? So your plant's complete. The next oasis might be having 5 plants in the pipeline that are all contracted. So you're going to go, let's say you're worth $100 at the beginning of the desert. You're worth 110 at the end of the desert. You're worth, I'm making this up, but you get the idea. You're worth 500 at the first oasis. You're worth 2,000 at the second oasis. You're worth 10,000 at the third oasis. So we have a major caravan that has come through the desert on 3 companies in particular in Fund 1. We think are going to all, utilities one of them, go through enormous value inflection over the course of this year as they get to the oases. But we got to prove that. Yeah. That's just in our head at the moment. If we do, we're going to have a very powerful model that's going to be highly scalable. If we don't, it's going to be viewed as an interesting experiment that didn't work. So that's what it really boils down to. No one's done this kind of investing before in private equity. Everyone sees the need, but just because there's a need doesn't mean it's a way to make a ton of money. And certainly Divert has turned the corner. It's worth many multiples of what we paid for it. And I think we're going to see, this will be the year where we're pretty confident we prove that the model works for those earlier deals in Fund 1 as well. But that's a big if.
Okay. So you've looked at the decarbonization space quite intensively. Are there areas where you feel there are serious technology gaps? There's not enough companies that are taking stabs at those problems?
Well, I think that one of the problems is framing, just to go back to it. So let's take a natural gas power plant. Here's the small ball stuff you can do. First of all, if you got a 1,000-acre site, or for God's sake, covered in solar and put in batteries. Why? Because you have the interconnect. Let's say you've got a 500 megawatt plant and you've got a gig of interconnect. Take that 500 megawatts, which you can't, would take you 10 years to get an interconnect on if you were coming from the outside. In an unregulated market where we would play power prices, and you can generate a really good incremental return on that. Now, you haven't reduced the emissions of the natural gas plant, but you reduce the carbon intensity of that power by 50%. Second thing you can do is blend fuels. So I think hydrogen for power plants is a real long shot. But there's ammonia, there's RNG. Most of the turbines today can handle up to 30% kind of alternative fuels. The long ball thing, and I think this will be covered this afternoon, is can you decarbonize that power plant by capturing the emissions on the back end? Can you uncouple the bad part of natural gas, i.e. the CO2, from the good part, i.e. unbelievable inexpensive energy density? And that requires a certain price on carbon, right? So the way we think about deep decarbonization in natural gas power is we'll do it when the price signal is there. It's not quite there yet. But we're better off owning that asset before anybody else, because we're going to know what the right technology is, and we're going to be able to build it at a lower cost than anybody else. And by the way, it may be not an amine unit on the back end of a nat gas plant. It may be direct air capture in the Saudi desert where there's all this stranded renewable power. So I think the framing problem is, well, you can only take 10% out now. You shouldn't be investing in that. Let's go invest in nuclear fusion instead. Look, I think nuclear fusion will come. I'm really glad people are spending billions of dollars on it. I'm not going to spend a penny on it. I'm not going to spend a penny on small modular reactors. I really, really hope they work. I think nuclear power is the thing that can save our planet. But you can't make any money doing it, in my view. It's just you're fighting against regulations, human fears, all kinds of things that make it a really tough place to invest. So in the meantime, there's opportunity anywhere there's pollution coming out of a smokestack. If there's a way to mitigate that profitably, that's a no-brainer. So let's think about an ethanol plant. An ethanol plant produces 99% CO2 off the smokestack. That's like $20 bills floating into the air. under 45Q. You get $85 a ton to stick that in the ground. Find an ethanol plant that's sitting on good geological storage. As long as you can get the Class 6 well permit, like you're printing money doing that. So, I'd sort of like to think about plumes of high purity CO2 going into the air. I view those as a huge business opportunity, provided you have the storage and provided that 45Q persists. And by the way, I think that's pretty damn likely, just given the current administration's posture towards the oil and gas industry. We've got companies doing work on sustainable aviation fuel, advanced biomethanol, and I would say we've gone from sort of despair there. It's like, where are the dogs? We've got the dog food. They don't appear to be hungry. In the last year, they've become ravenous. And there's real movement in those arenas such that we can build plants and generate very good profits doing it. And there's a real depth of market. So it's, one of the questions we get is, well, do you rely on regulations in the US? Absolutely not. You can't, because they can go away. But you can get benefit from them. Can you rely on regulations in Europe? Just about, but not entirely. I mean, Europe itself, the whole EU may abandon its kind of decarbonization goals if its economy keeps getting hammered the way it is, especially Germany's. But you have to assume, for instance, that SAF, even if EU regs go away, will have a portion of airline sales because they've made corporate commitments, et cetera, that they will probably stand by. So green fuels, critical materials. So we have a company that makes magnets with rare earth metals in them. We have the only non-Chinese supply chain in the world. We're building a plant for GM in South Carolina as part of the Inflation Reduction Act. GM gave us a very nice 10-year take-or-pay contract to build those magnets. Now all the defense contractors are coming to us and saying, we're not so sure we want to be dependent on China. And so those magnets enable electric vehicles to operate. They enable, as a sidebar, a lot of weapon systems and aviation systems to operate. They enable semiconductors to perform. So critical materials, in that case, that have a serious decarbonization benefit when you talk about electric vehicles, but also have a great industrial application in other arenas, is those kinds of businesses where you're benefiting from the kind of the animosity with China. We like those areas a lot as well.
If you look at energy storage more broadly, have you looked at it? Are there investments that you're making? I mean, there's Blue Whale Materials that's taking, but it's more of a recycling play than.
Yeah, Blue Whale Materials is a whole lithium-ion battery recycler, and I think that'll be a nice business. It does. When you think about an electric vehicle, it's like, does it really make any sense? The carbon intensity of building that battery means, if you really just do the practical math, you're better off buying a Honda Civic. But that changes if the batteries are recycled. If you can reuse that material over and over again, it fundamentally changes the carbon profile of electric vehicles. So I think there's a lot of animus towards electric vehicles. If you look at the new build, and then scrapping it versus a new build and then reusing all of the materials, in which case it becomes pretty compelling from a carbon perspective. So on carbon capture, without getting into names, we're looking at a direct air capture business. I never thought I would do this. I always thought it was just absolute insanity. The costs for some of the more kind of Gen 2, Gen 3 technologies in that space start to look like they will stack up favorably versus actually making, for instance, sustainable aviation fuel or green, advanced biomethanol or green ammonia. I never thought I'd see that. It's happening. It's happening faster than people think. And what you hear from off-takers is, why don't I just use conventional fuel and just build something in the desert and do DAC? If that works on a scalable basis, and if you can get the cost per ton down, let's say to 100, 150, you've got something that's really exciting, because you can just start to build those modular plants at high speed. You have to have a modest price on carbon, but let's just think about what 150 a ton means. That's 50 cents a gallon. If you have a revenue neutral carbon tax at some point, which a lot of places do already, then you've got something that could really scale massively. So that watching DAC, which again, I just, when it was sort of, well, we'll be at 500 a ton in 15 years, I just thought that was madness. That was like green steel. The cost curve is coming down so fast that you may be able to own a natural gas power plant and offset your emissions in the Saudi desert with 1 cent, literally, renewable power. So there's this kind of consciousness that, number one, you have to get to 100% decarb. That just stifles a lot of really good innovation. There's also this notion that you have to capture the pollution where it sits, right? Like, so if I'm bringing 5% CO2 out of a natural gas power plant smokestack, I've got to get that CO2, I've got to get those molecules on that site and put them in the ground right there. That's just nuts, right? All CO2 molecules are created equal. So find the cheapest ones in the best location with the cheapest, renewable or stranded power, and you could start to offset natural gas power plant's emissions in Ohio and Saudi Arabia. There's no reason that doesn't make all the sense in the world. So uncoupling those things in people's minds is really important.
What's the overall sentiment like now going forward? I mean, we've had the election, we've had the Trump administration come in. You've talked a little bit about some of the pressures in Europe. A lot of your businesses, because of the screening criteria that you use, right, are not overtly dependent on incentives. You'll take advantage of that where you can. But is there a knock-on effect on the ability to raise the next fund in the decarbonization space? Is that sentiment kind of weighing down on your LPs who might be interested in looking at the next set of funds that you raise?
We have a large investor in Texas, a public plan, and if we mention decarbonization when we go into their office, they will club us. They're in it for the money, and if that's the way we make money, that's fine. We better not talk about it. I mean, it is funny how many U.S. investors say we just don't care about that stuff. So you can be, Charles, you can be cause-driven or whatever. Just make us money. If you make us money, we're happy. We don't care how you do it. In Europe, it's quite different. In Europe, there are, so we have a number of, for instance, Swedish and Dutch pensions who invest. What they would say is, boy, when we talk about climate investing, you're the first people we've seen who are mercenaries. Like, you're in this for the money and the returns. It's not kind of, impact investing can often be code for crappy returns, right? Like, we're wearing a hair shirt and we're virtuous and we're going to lose your money. So in Europe, I think it's just that we are at the intersection of returns and decarbonization. We view decarbonization as a means to make money. So I don't think that's going to go away. We have a tailwind, unfortunately, in our business, which is it's getting hotter and crazier all the time. So I think it'll go through ebbs and flows. But I think that the sort of long-term macro trend is not going away. And it's really hard to say that in Texas. I spend a lot of time here, and when you're talking to investors in Texas, maybe particularly, but in a lot of the US, they don't recognize in the rest of the world. Like, you go to Korea, you go to Japan, you go to certain European countries, like, they're strapped on their helmet and they're going, man. They're not going back. And in the case of Korea and Japan, it's quite interesting. They're being annihilated by China. I think it's tough for us competing against China they're right there. And the Chinese are just crushing them industrially. They view decarbonization as a way to extend the shelf life of their industry and their competitive advantage. So I don't see it going away. I think maybe the pockets of enthusiasm shift a little bit. I think there are ebbs and flows, but as long as we can make money, we'll be fine. It doesn't even matter if we're in climate or not, right? So at the end of the day, it's not about climate as a macro, it's about investing profitably in decarbonization as a macro.
Excellent. Let me open this up to questions from the floor. Nisha Desai at the back, please.
You could see that you could see people kind of building whatever they want here for power and then really just kind of offsetting it with DAC in the Middle East with 1 cent renewable power. Is that your perspective in terms of really what's going on right now, of course, with the big, AI build out for data centers and looking at power resources for that? Do you see a lot more kind of gas-fired generation really powering the data centers?
It's a good question. I mean, the price signals still, other than maybe in Northern Virginia, the price signals aren't there to profitably build new natural gas power plants. The reason we're going to make money doing it is that we're buying plants for 20 or 30 cents, 20 or 30% of their new build cost. So what happened was everybody built plants. The price signal wasn't there, so they had to everything had to be priced up to perfection to make them work. And a lot of the stuff we're buying is from distressed debt shops, from banks that ended up owning plants that were just too expensive given the price signals there at the time. That's by and large still the case today. It's very hard to build things in the US. It's very expensive. And outside of that one market, around DC, we just don't see the price signal. So what we're doing is optimizing plants after we buy them and then figuring out how to offset in the most efficient way. Now, if prices increase substantially, and we are going to face a crisis in power in the US before too terribly long. Because if those new builds don't come and the price signal isn't there, then you use up all the power you've got, and then there's a long time till you get more, right? So the best way from an investment perspective that we can play this is to buy plants at the right price at a fraction of their new build cost, and then to look to offset those emissions. And by offsetting, I forgot to mention one thing, if you can deeply decarbonize a natural gas power plant, you can sign contracts with the Microsofts and Apples of the world, the people who need, massive amounts of data. You can sign contracts at higher prices. So not only is there $85 for sticking CO2 in the ground, not only in RGGI are there avoided penalties of $20 a ton today, now you're at $105 a ton. If you can get higher prices for your power, now you're at a place where you can start to actually pay for the offset. And whether that's in Saudi Arabia or whether it's an amine unit right on your plant, that just depends on the economics. But what's missing today for new builds is the price signal on power. What's missing today for mass decarbonization of natural gas power plants is the price signal on getting rid of the CO2. It's close, but it's just not quite there.
Thanks, Charles, for the great insight. My question is with respect to the recently released Treasury guidance on 45B, right? How do you see it is going to impact the blue hydrogen and green hydrogen? And do you see that the current administration change is likely to impact? If yes, what are the areas?
I'm laughing. We were just talking about this earlier. Like, since Donald Trump doesn't know what Donald Trump is going to do in the morning, it's very hard to predict. I will say this. Some of you may be familiar with Battelle Labs, which is this giant R&D shop in Columbus, Ohio. I just happened to be with them the other day. They just went and spent time with 20 Republican senators. And the feeling is that the hydrogen hubs aren't going away, which really surprised me. But look, what the IRA was in a sense was a giant social experiment, right? Like, if we feed the drug to the red states, if we get thrown out of power, which they did summarily, Democrats, will those red states actually want to keep getting the drug? And the answer seems to be yes. So, there's a DAC plant getting built in Mike Johnson's district, and everyone's like, oh no, well now it's, to the contrary, he loves it. The Republican senators from Louisiana love it. So there appears to be enough support for the hydrogen hubs and continued hydrogen investment at this moment in time, but it's very hard to predict. So we would say kind of better than 50% chance today that funding continues, but take my prognostication for what it's worth, which isn't very much.
Thank you. Good morning, Charles. Thank you for your discussion. Question for you about your company. A lot of private equity companies have got access to vast sums of money. I'm sure your company has access to that too. But in terms of getting your portfolio companies to be successful, What's the secret sauce that you all have that distinguishes you from some of the other PE firms? And what do you give to management teams in order for them to be successful? Because a lot of companies do go bust, as you pointed out previously. Thank you.
Yeah, well, when I was doing straight buyouts 20 years ago, you'd go buy a business and you tell the management team, I want you to put all your money into this. You get stock options, but you got to really feel the pain. You got, mortgage your house. You feel the pain with us. We're putting our money in on behalf of our investors. It's not like that in these companies. If it's a process technology rollout, they're signing up for 5-10 years of hard work with a potential huge payout at the end. And so what you don't need to do, or I just don't feel comfortable doing anymore, is asking them to, they're already probably taking a hit in salary and bonus, right? If you're coming out of let's say you're coming out of a really good job at Exxon, the idea is on a probability weighted basis, you're going to make much more over 10 years. But that's assuming that, the stock options hit. So we don't need, since you're sacrificing current comp, I just don't see the need to ask, management teams to put their money into the deal. That's number one. Number two is, hopefully we are seen as patient, strategic capital. The hardest part of this business is how long it takes to sign contracts, right? I mean, the sales cycle is eternal. Now, once you get those contracts and you get to that oasis, you've already taken the huge first jump in valuation. So I think you need management teams that understand how long the journey is going to be, appreciate what the reward can be, and then they also have to be really comfortable having our builder team and our kind of very hands-on approach be a strategic asset and not a pain in the ass. And it's, for the companies that started without that full builder team, it took some work to get them to sort of accept the new regime. For the companies that we're going into now, they really view it as a plus because that team has been going through diligence with them and helping them understand their economics, et cetera. So if a company doesn't want to work with us to modularize plant design, put a very disciplined stage gate process in place for construction, et cetera, it's probably not going to work. So I'd say it's really a shared worldview on what the prize is, how long it takes to get there, and what the best path is to get there.
So, Charles, hi, this is Jim Sebo from RPE, and yeah, I'm totally on board with where you're at on nuclear fusion and those type of technologies, since we deal with those internally. But my question is, what are your challenges of trying to monetize these new technologies around carbon and process? I mean, you're talking about project engineer, having a project out there, and then integration of those components. And typically, you don't have one vertically integrated company doing that. And that, to me, is kind of the challenge I'm trying to figure out. So if you can lend some insight there, I'd appreciate it.
Yeah, that's a great question. So we have a waste gasification company called Jadara. We back in 2020, we canvassed the whole world. We thought they were hands down the best way to gasify waste. And from there, you can go to advanced biomethanol, you can go to hydrogen ammonia, SAF. The magic happens in the gasifier. This company, it was a German technology. They had 4 plants operated in the 90s at 90% uptime. They worked like a charm. They didn't make money because there was no premium on methanol at that point. So we'd show up at customers and say, guess what? We have the gasifier that makes the magic. And the customer would say, we don't want gas, we want SAF, or we want methanol. Now you're going to make us go figure out which pots and pans go on the back end. We don't do that. You do that. So it was long story short, we will be announcing a major consortium with leading pot and pan manufacturers who did the same exercise we did, picked our gasification technology. So we've gone from sort of a desert of opportunities to suddenly just a tidal wave, because those companies have massive sales forces that are out there selling the processes. So the answer, sometimes you're acquiring a company that has the whole solution. So for Divert, for instance, on the RNG side, like they have sort of an end-to-end solution that involves logistics and software and obviously the gasification piece. So that's a lot easier because you are that integrated solution and package. If you have a component in a larger system, getting to that consortium with which by the way is also sort of an implicit validation that you're the best technology is super, super important. So we would rather operate as an integrated solution rather than a really cool piece of kit in in a broader package, which is just much harder to sell. I don't know if that answers your question.
Well, we'll wrap it up at that. Charles, thank you so much. Much appreciate you taking the time here. Super insightful conversation. Hopefully you'll stick around for a little bit more today. There's lots of interesting stuff happening. But thank you again, and let's give Charles a hand.
Thank you. Thank you.